Welcome to The Explainer. I am so thrilled you're joining us today because, wow, if you've been watching software stocks lately, you have absolutely seen the fireworks. We're going to unpack the historic 17.8% single-day surge in Workday's stock. But look, this isn't just about one company having a phenomenal day on the market. We're going to zoom out and dig into the broader mystery of how artificial intelligence is completely reshaping the entire software sector, and why this one massive piece of news might just be the turning point for a trillion-dollar industry.
Okay, let's just quickly run through our roadmap for this explainer. We'll start with Section 1, the $8 billion surge. Then, Section 2, inside the AI SaaS apocalypse. Moving on to Section 3, Silver Lake's contrarian bet. After that, Section 4, debating Workday's true value. And we'll wrap things up with Section 5, what to watch next.
All right, Section 1, the $8 billion surge. Workday's historic single-day jump.
So, this whole wild sequence of events was actually kicked off by preliminary reports that private equity giant Silver Lake was discussing an acquisition of Workday. And the valuation they were throwing around? A staggering $43 billion. The sheer scale of the market's reaction to this was just unbelievable. In a single trading session, Workday added an astonishing $8 billion to its market cap. Literally overnight, it leaped from a valuation of roughly $43 billion to over $51 billion. I mean, that is a massive, massive injection of capital and confidence in a remarkably short window of time.
The intensity of this rally was something else. Shares closed up 17.8% at $206.45. In fact, the buying frenzy was so intense that trading literally had to be halted multiple times just because of the sheer volatility. This ended up being Workday's absolute best single-day performance in 10 years. And to put that into perspective, right before this news dropped, Workday was actually down about 15% for the year. They had fallen over 40% from their 2024 peak. And just like that, this single day erased all of those year-to-date losses. But, and this is a crucially important caveat, we have to note that these talks remain completely preliminary. There's no definitive agreement, and honestly, both sides have been keeping pretty quiet. So this entire rally is built on the prospect of a deal, not ink on paper.
Let's move to Section 2, inside the AI SaaS apocalypse. Why Wall Street panicked over software.
To really grasp why that $8 billion surge is such a monumental deal, we first have to understand the crushing pressure that software stocks have been under lately. And it all ties back to this concept of the SaaS apocalypse. This is essentially the widespread market fear that artificial intelligence and automation are going to severely disrupt the traditional software as a service or SaaS business model. The public markets have been aggressively dumping these stocks because there is this fundamental panic about how these companies are actually going to make their money in the future.
The core of this business model crisis is actually pretty stark. Traditional SaaS companies, like Workday, charge their clients per user, or per human seat. So, if you have 1,000 employees using the software, you pay for 1,000 licenses. Simple, right? But in this impending AI future, if AI agents start doing the work that human employees used to do, you naturally need fewer human seats. So the whole logic of paying by headcount simply starts to fall apart. Like, why pay for 1,000 human users when an AI can just automate a huge chunk of that administrative work for you? That exact fear is exactly what has been driving the entire software sector down. However, Workday definitely hasn't just been sitting back and taking it. Despite the market panic, their underlying fundamentals have actually remained incredibly strong. Just last quarter, they posted a 13% revenue growth, hitting $2.54 billion, completely beating expectations. On top of that, co-founder Anil Bhusri actually returned as CEO back in February, specifically to help steer the company through this exact AI transition. But because of that overwhelming SaaScopolis narrative, Workday got grouped right into the panic anyway. It really just proves that in today's market, even rock-solid fundamentals can't shield you from AI anxieties.
Which brings us to Section 3, Silver Lake's contrarian bet. Why private equity is buying the dip.
And this sets up the central mystery of our explainer. Why on earth is a sophisticated private equity firm circling a company that the public markets have been so eager to punish? Well, let's look at what the analysts are saying to unravel this. Kirk Mattern, an analyst at Evercore ISI, said, "The terminal risk related to AI for certain enterprise software companies is potentially overdone." To translate that financial jargon for a second, the market basically panicked and overcorrected. For established companies that already have immense scale, AI might not be the existential threat everyone is fearing. It might actually be a massive untapped opportunity.
Building right on that, we have this great insight from Jefferies analyst Brent Thill. He notes, Workday's business is unlikely to be displaced by AI. Becoming a private company could actually accelerate its AI transition. Just think about that for a second. The public market scrutinizes these companies quarter to quarter, right?
If Workday goes private, they suddenly get the breathing room they need to heavily invest in and integrate AI, without Wall Street breathing down their neck every 3 months worrying about short-term profit margins. And then, Constellation Research CEO Ray Wang makes this brilliantly blunt point. He says, SaaS companies have data, they have distribution, they're still going to win. It's so true. AI desperately needs data to function, and these massive software companies already hold the keys to all the enterprise data in the world. Furthermore, market analysts like Dan Niles have pointed out that a massive private equity buyout like this could effectively put a protective floor under the entire software sector. It signals to everyone that, hey, these companies still hold immense inherent value.
Section 4. Debating Workday's true value. Is it deeply undervalued or still too expensive? Let's break down exactly why the public and private markets are looking at the exact same numbers here and fundamentally disagreeing on the price tag. Starting with the bull case. Platforms like GuruFocus and discounted cash flow models are estimating Workday's intrinsic value is anywhere from $319 to $342 a share. That is massive upside. The bulls point to a remarkably healthy business generating about $2.9 billion in free cash flow annually, and that's supported by an entrenched base of over 11,500 customers, including total giants like Netflix and Thomson Reuters. Plus, they already have $500 million in annual recurring revenue tied specifically to AI from over 4,000 users. But flip over to the bear case. The average analyst target was sitting way down at $170. Bears argue the stock is already priced for absolute perfection in a landscape that is just filled with heavy competition. And they view all that early AI momentum as pretty unproven in the long term.
And you can really see the bear case argument when you compare the multiples. Workday trades at a steep premium, a 60x price-to-earnings multiple, compared to an industry average of just 33x. That is a very hefty price tag for an acquirer to justify. That being said, this narrative is shifting incredibly fast. Firms like Wells Fargo have recently raised their price target to $215, suggesting that maybe this premium might just be warranted after all. All right, finally, Section 5, what to watch next. 3 major catalysts for the software sector. I want to guide you through the exact events you need to keep an eye on to see how this all plays out. Step 1 is deal certainty. We have to see if these preliminary talks finalize or if they fall apart. Because if they collapse, the stock could very easily give back all of these sudden gains. Step 2 is the big one, Q2 earnings, which are scheduled to be reported on August 27th. That earnings report is going to be the ultimate stress test to see if Workday's underlying business actually justifies this massive new $51 billion valuation. And step 3 is monitoring sector sentiment. We'll be watching closely to see if other private equity firms step in to scoop up other software companies that the public markets have undervalued. And hey, if you're out there wondering if Silver Lake can actually pull something like this off, just look at their track record. This is a firm that handles unbelievable scale. They recently executed a $55 billion buyout of Electronic Arts, and they are one of the managing investors behind the U.S. wing of TikTok. So yes, they absolutely have the capital, the precedent, and frankly the boldness to execute one of the largest software buyouts in history. Ultimately, this entire explainer boils down to one incredibly provocative question. Is AI an existential threat to traditional software, or is it the ultimate opportunity? The public market has been absolutely terrified of the threat, but Silver Lake's massive reported bet sends a shockwave signal to the entire sector that the opportunity is actually what we should be focusing on. Thank you so much for joining me on this deep dive. Make sure to keep your eyes peeled for that August 27th earnings report, because honestly, the future of the software industry might just depend on it.